Loans. I'm here with Chris Hood, professional trader, world's most interesting man, and he is going to tell us, he's going to give us some thoughts on the market and some trading strategies. So,
What's up, Mr. Jones?
how are you?
I'm good, man. I'm good. I feel sort of liberated that this must be how the people felt at the end of World War II when they were told it was all over. They can now go outside of the house.
Yeah.
So we got a bit of a reprieve on our lockdown starting today.
So what are you allowed to do now?
I can finally get a haircut. Finally. I just want to say to everyone who's watching this, next week you will see a completely different look. So I'm going to go for that. And gyms are opening. Not so sure about the jiu-jitsu just yet. I'm holding thumbs, hoping that I get an email later today saying, it's time to come and kill. So we'll see. We'll see. Hopefully, I just feel a little weak. I'm wondering that these young guys are going to come out and just beat the crap out of me.
It's going to
be in trouble.
It's going to happen. It's going to happen. That's how it works.
Thanks for the encouragement.
But I mean, you know how it goes. I'm not telling you
anything
you don't know. Then you'll get back into it and everything's fine.
I just have to remember, I won't be able to use my hair to defend myself. I'm just going to have to use guile and cunning. So thumbs in the ribs every now and then.
Yeah, that's it. You got to be a deceitful, tricky old man jiu-jitsu. You just got to.
Now you're talking my language. Tricky, that's the thing, man. Tricky, that's the thing.
Yeah, the psychological war. So, I mean, the market just keeps climbing.
Really interesting, man. Really interesting. One of the things that I try and do on the weekends is I surf around and I look for evidence of exuberance, where people are just a little bit too excited about things. And one of the things that has certainly come up over the last couple of months is the plethora of hacks and simplicity and all of these guys on websites and YouTube and whatever promoting, this is easy, right? And, come along, pay us $5,000 on a weekend and we'll make you an expert. And, there's a part of me that says, I'm really glad that people are getting educated. But there's another part of me that says, this is really bad. Because if you're going in and everyone now has a belief that after a 5-minute course or a 5-minute video, they can now do things, it's pretty dangerous, and this is real money that we're playing with. This is not a game. And, GME and all of that stuff, the amount of people who lost on the reversal doesn't go to the news. We're not seeing that in the news. No one on CNN is reporting how many people lost money after having bought GME at 483 and now it's at 60 odd. No one, there's nothing there, right? So
everybody loves a success story. They don't like that.
Yeah, and I think that we've got to be really careful. And I really encourage people who are watching this to just remember it's your money. You've worked hard for it. And if you treat the market like a casino, it's going to treat you like a gambler. And we all know that when you go into a casino, the odds are stacked against you. And there's a certain element of psychology that comes into it, right? They want you to win easy, maybe for the first couple of hands, so that you get committed into it. And how many stories have you heard of people going into a casino saying, I've only got $1,000. I'm just going to spend $1,000. And before you know it, they've gone to the ATM, drawn another 5, lost that,
I've gotten a loan from the bank that's in the casino.
Mortgaged the parents, forget the house. They've sold their parents off to slavery somewhere. and now they've lost. And I think this exuberance in the market, or this impression that it's easy, is false. I don't want to give any illusion that what I've managed to build for myself over the last 20 years happened in a weekend. It didn't. It happened after years and years and years of losing. And because I've lost, I really appreciate and respect the fact that I can win now. And one thing that you've always got to remember is, if it's easy, if you gain something easy, you're not going to hold on to it easily. The money is one of the few things where more is not often better. And I know that sounds a little crazy, but if you think about it, if someone, when you read those stories about lottery winners who won easily and they got $30 million or whatever it is, and within 5 years, they've lost it all. it's the same thing in the market. And you've got to have a process, and you have to have a plan, and you have to be willing to look at the market as a long-term value creating entity as opposed to a short-term lottery. I've hardly in my life met people who've made lottery gains. Hardly.
Right. Consistently. I mean, the consistency is the key, don't you think?
Yeah. Consistency is everything in a trading career. We can't hunt out single winning trades. It's hard to find. People who got into GameStop early. I mean, we traded GameStop last year under the same auspices, right? We were sitting there going, this is going to be a short squeeze. And that one of the key things I look for is short interest in trades, because over time, that's going to then flow out, right? We've been in GameStop. We got out of GameStop with a 300%, I think it was. And then we move on. We find others. And we've got others that we play. But we don't look for the euphoria. We don't look for the social sentiment. I'm not looking for trades where they only work because of 6.7 million people reading a chat group. I don't want that. That to me is inconsistent. So, I mean, I wanted to show guys, this is the type of consistency that we have in the strategy that we use, right? So this is how we trade, right? So in October 23 last year, I made some changes to some of the strategies that we use. And it took a couple of weeks, took 2 weeks to adjust it. But I want to focus on one thing. One is the consistency of the income that we generate and the low capital that we use, right? So our average capital usage per week is around 25,000, and the income that we generate is somewhere just under 10. All right. Now, I'm going to put some disclaimers here. First one is the period from October to March, generally speaking, is a really, really nice time to trade. So it can be a little easier. All right. So if you're making good money between October and February, you won't be able to make the same numbers with the same level of effort from sort of March to September. It doesn't work like that. In my 20 years, I've never seen it be consistent. It's very much different the whole year, right? There's seasons to this. That's number one. Number two, the key elements here are not the dollar value. This is a side thing for me. The fact that it's profitable is driven by two ratios on this page. And this is something that most traders don't follow. Most retail guys do not look at this. Most retail guys only look at their P&L. They only look at this. They make decisions based on this. They only look at that. Okay. There's two things here that count to me. The first one is this column here, which is the win rate. How many trades did I actually make money on? All right. So last week, we did 55 trades. We won on 38. That's a pretty good win rate. That's 69%. What's important here is how much did we lose? So when we lost on those 30% of those trades, what was the average size of the loss? And last week, it was pretty dismal for us. Okay, it was 1% better. We were making 1% more when we won than when we lost, right? The fact that we won a lot more kept us alive, right? So if I had a win rate of 50% and my ratio was exactly the same, I probably wouldn't have made any money because exactly what I was winning, I was giving away. So as retail traders, you have to focus on two things: the gap between your wins and your losses, which forces you to plan your trades better, right? So if you're losing more money on average compared to when you win, you have to fix your losses, right? There are some of the world's best traders have win rates of 44%. All right, they lose 60% of the time, but when they lose, they are losing such small amounts, and when they are winning, they are making such big amounts. Their profit ratio is in the triple digits. All right, they do that. Some of the best traders in the world have got numbers like that. So I'm still getting there. My goal is to get this number closer to 2 by the end of the year. But what's important here is you've got to focus on consistency. You don't build a trading career having one good week. If someone comes to me and they go, oh, I made $300,000 on GME, I go, well, now your goal is to keep that $300,000. Because if you've been emboldened by that one trade and now you're going to risk the 300,000, I'm going to be pretty sure if you don't have a lot of experience and you don't have a plan, I can put money on it that you're going to lose that $300,000 within the next year. And I can show you something. When you look at GME itself, all right, there's certain indicators on this screen that tell you buying GME on this day, on the 28th of January, was a stupid idea. And most retail traders would not even look at this page. All they've done is they've taken a phone call from their buddy and said, you know what, let's go buy this stock. But there's certain things on this page that will tell you this was a bad idea. And one of them is these 3 yellow lines to the top and these 3 red lines to the bottom. What these represent are trading ranges. And most stocks trade within a range of 1 Keltner channel. So Keltner channel is just a risk measure. It's a measure of the volatility or the range of the stock's price. It trades in the range. This stock was so far out of its range, it was inevitable that it would come back. So the clever traders, they bought somewhere down here on the signal that we have at the bottom, the histogram moving up. They would have bought here and probably exited there because it's so far now above the 3rd range. Stocks don't trade in that 3rd range for long. Once they get past that line, they're coming back. Here, it was 2 days. Bang, within 2 days, it came back down. And then with another 2 days, it was down back to the mean. Stocks always go to the mean. They don't stay extended for long. Let's look at a couple of other ones. Let's pick a few names. Let's look at NEO, another popular stock. So look at NEO. Staying in the 3rd range, pullback. Trading along the middle, extension, pullback. You don't want to be buying it when it's there. You want to be buying it when it's there. So patience pays off. And it's the same thing when you're looking at learning this game. Be patient. Give yourself time to understand the strategies and how they would work. Now, how would we use this? How is this used in a very simple trading plan? Well, if I know that this stock is trading in its ranges, I know where it's extended, so I can see when it's overextended. Excuse me. I'm going to quickly add just a small Fibonacci analysis from here, from the top, to its low there. Now I can see where the lines of support and resistance are. And I can see that the 8, this blue line, offers a form of support. When it goes below the 8, it comes back to the 8. Goes below the 8, comes back to the 8. Goes above, comes back to the 8. So from here, we could probably see if this was going blue. So if we had a little blue bar forming at the bottom, we would know that there was some element of forward-looking upward momentum in the price of the stock. Now, there isn't one. So I don't want to be taking any sort of directional bias until such time as the direction is set, right? So the key lesson here is don't buy at the extension above the 3rd Keltner. Buy it when it pulls back to the 8. This is always the safer entry. If you are sometimes like me, where you look at these trends and they can be pretty strong. You know, this one here, you can see that the trend is pretty strong. We have rising upward momentum and the stock is trading between the 2 and the 3, 2 and the 3, 2 and the 3. Now it's above the 3. Would this be a bad place to enter? Not really, because what I could do is do a 1/3 of a position. Because if it does pull back, I could add my second 1/3 and average into the trade. If it continues to grow, I've at least got exposure to the trend and I stay into it. So sometimes if you've got a trade plan that's too dogmatic, that says, look, you only buy at this point, you will miss this. You will miss that. So if you don't want to miss that, buy a 1/3. Wait for it to pull back, add your second 1/3. Now I've got 2 positions. I could have taken profits on the one that I entered here over there. I would sell it on a pullback to the 8. Okay. Now I'm exiting the first position, made my profits. Wait. I need 2 bars closing above the 8 before I buy again. So there's no 2 bars. 2 bars. They're my 2 bars above the 8. Buy now. There's my buying signal. I would have bought here, sold there. So it's a very simple pattern. It's a very simple strategy, but it appreciates perspective. All right. Just buying it on price is not relevant. And a lot of retail guys need to understand that. It's not just about price. If it was just about price, what then encouraged people to buy here? Someone bought that.
I wouldn't want to be
Someone
that
bought
person. I would not want to be that person.
But you got to, the thing is that when you go online and you see that some of this garbage that's out there promoted by these guys that are making far more money from you, buying their course as opposed to them actually trading, right? They make a lot more money that way. You can't be an expert on this in a week. And your expectations shouldn't be that you'll be an expert. This takes time. So be careful. Anyone out there, if you're looking to drop, $13,000 for a course on a weekend, with some weekend expert, be careful. Buyer beware. A lot of this stuff is not, I inherited a lot of clients who had traded their way to blowing out their accounts because they'd gone on a weekend course and had perceptions that they were experts.
That reminds me of those weekend self-defense seminars. Learn how to kill any attacker in a weekend.
Yeah,
it's like it's a skill, and I can speak to the fact that it's easy to get overconfident and take a big loss, and then realize that, well, there's a lot to this. And I mean, it's one of those things where I think it's that model of where you have unconscious incompetence, the conscious competence, and kind of you move up, like you don't even know how much you don't know until you get into it and you realize that it can.
Yep, absolutely. If I look at the journey curve of most of the beginner traders that I've worked with, a lot of them start off with a seductive sale, right? They always start off with having been seduced by something, and it's usually yield. Yield is the most common way to sell a strategy to someone. If you go to someone and say, your cash deposits at the bank are generating 0%, I'll give you 10% a year, selling naked puts, all right? For example, short puts. And they go, okay, cool, I'm going to do that. Let's load up some money in there. And they make their first trade, they win, and then they win again, and then they win again. They go, this is easy. I've won 3 in a row. They don't look at perspective, so they don't realize ranges or anything. All they're looking at is premium. And premium is an indicator of risk. The higher the risk, the higher the premium. That's how it works. So they start selling these really expensive premium put options under the guise that, oh, I won 5 times. I'm not going to lose. I know how this works. They load up. Market corrects. When we say correction, we don't mean for an extended period of time. It only has to drop down for maybe 3 or 4 days. And that position is now toast. Can't get out of it. Got no liquidity. Can't get out. Broker now phones you up and says, you've got to put more money in to cover the contractual obligation of your position because you've used all your margin. What do? 1 week from now, the position might be completely different. The stock might have moved up, but your broker doesn't care about that. He cares about the now, right? He doesn't care about 2 weeks from now. You can't say to him, give me an extra week. He will start liquidating your account in 3 days. If you don't put the money in, he starts closing your positions off.
But that's like trying to get extra time from a loan shark, one of these.
Yeah, he's going to break your knees with a baseball bat. So the thing with trading is have a plan. The first thing that saves you from all of that stuff is having a plan. No, and to have a plan, the first thing you do is you agree what your outcome is going to be. What are you trying to do out of this? If someone comes to me and says, oh, what should I do with this trade? I always say to them, well, what did you want to do in the first place? Oh, I don't know. I can't help you. If you don't know what you were going to do, how am I supposed to tell you what you should do? Because I don't know where you're trying to get to. So it's really, really difficult. And I think a lot of people are seduced with the Facebook ads and the YouTube. Everything is just easy. Everyone's looking for a simple, easy hack. And the hard part about this is there isn't one. and it's going to take you losses to realize it. And, I feel really bad, because looking over the internet this week, I told you before, I touched one of these little ads, and now Facebook gets the cookie and just keeps throwing them at me. I've never seen so many experts and so many people selling falsely. I think that's false. And I think that they're seducing people into believing that this is a no-lose kind of situation. And it's going to result in a lot of heartache and a lot of tears, because they don't teach plans. They don't teach perspective. They don't teach anything. All they teach is, yeah, go sell this, make this, and you'll be okay. And they don't tell you what will happen when it goes wrong. And
So I have a question. I have a question. Do you think that, options seem a little more complex than stocks for trading strategies?
Yeah.
Because you can do more things with them, and you have the leverage, and you have the ability to make more money off of less money, but also to lose more money quickly. Do you think that sometimes that the stock strategies may work a little better in that sort of simpler format, or no?
No, I don't agree that you can lose more with options. See, the thing is this: if I put down an option for $1,000 on Microsoft, I can only lose $1,000, right? If I buy $24,000 of Microsoft shares, I can lose $24,000. So with options, it depends how you use them. All right. The only time you can lose more on options than what you've committed, so your risk reward is exponential, is when you do things like naked transactions. You sell a call option without owning the stock, or you sell a put option without having cash to cover the obligation. That's when you can lose your pants. And most people do lose their pants doing naked transactions. There's a couple of stories on the net of hedge funds that have gone absolutely belly up because they were doing short calls and short transactions, uncovered transactions, and that's where the risk lies. But me doing a bull call debit spread that's set up correctly on a stock like Microsoft, I only lose the debit paid.
You got defined risk strategies versus
much more. Yeah. Totally. And I think with stock, I always compare stock to travel. So trading is like traveling. All right. If you want to fly coach for your entire life, buy shares. That's it. Because you're never going to get exponential returns. It's going to take you a long time. The journey might be, okay. You're not going to be getting the nice meals, but you're going to be eating a meal on a tray with some plastic cutlery, and you're going to be cramped with everyone else. Options are like business class. That's the way I see it. Option traders are like people who fly business class. They get better seats. They have far more options available to them to make the journey a little bit more comfortable. They don't get to the end at a different time. This is the thing. I'm not going to get to my end of journey at a different time to you if you buy stocks. It's just our journeys are going to be different. And our destinations are probably going to be different as well. Guys who buy stock, who don't want to sit in front of the screen, don't want to learn the trade strategies, probably are the same people who always say the market went against me. So you can always tell the type of person is when, the market went against me, it was never my fault, blah, 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 blah. Those guys, no, they don't need to trade options. Option traders, the guys that I work with, are very specific because the market doesn't go against someone who's done their work. Because you've already thought what the market's going to do and you've already planned for it. Where it catches people out is I have no plan. My buddy over there told me to buy the option, so I'm just going to go and buy the option. Let's see what happens. They don't know when to get out. They don't know how to take their profits. And 90% of the problem with options is people don't know when to leave. They don't know when they've made enough to actually go somewhere else. They stick around too long. It's like that horrible family member that won't leave home at the Christmas dinner. That's a normal retail trader with a long call option. They just don't know when to get out. So this is the biggest problem right now, is that everyone thinks it's easy because there's so many ads saying it's easy. It's not easy. This is hard work. You know it. You've been through the training that I did with you. And, when we started off, the first 6 to 8 weeks, it's like learning Russian. Like if you don't speak Russian and you go into a Russian class, you cannot download Russian like a matrix USB into your head. It takes you weeks and weeks and weeks of practice and immersion to really understand Russian. Same thing with options. If you're going out spending 13 grand thinking you'll be an expert at options in one weekend's course, good luck to you. That's what I say. Good luck to you. There'll be very little sympathy at the end when you've lost. That's the way I am, because I look at it and I go, I spent 20 years going through the same learning curve, making mistakes after mistakes after mistakes after mistakes. No one taught me how to do it right. I had to teach myself. And then I look at these guys going out there and taking advantage of people who really want to make a difference for their own financial future without telling them the bad side of things. I think that's disingenuous. I think it's really unfair, because when the people lose money, they've got nowhere to go. You know, where are you going to go? You're going to go back to the guy who taught you how to lose? Like, it doesn't make any sense to me. So it's a very sad state of affairs. It is a sign of a euphoric market. It does make me a little nervous from an overall market condition perspective. Like, when people think that you can't lose, that's when you lose. You know, it's so, you know.
But with the market, it's just climbing and climbing and climbing. Haven't really had any major pullbacks. So a couple little ones.
Yeah.
I mean, do you see any kind of correction? I mean, would you?
You know, I think that there will be. How big, how deep, when?
Yeah.
Anyone's guess. I think that there's more bullish news pulling stocks up. I think it's very dangerous to be on the sideline right now, because you will miss out on the gains. And I think this is part of the problem, is a lot of the hedge funds that pulled out when they were doing the GameStop debacle are on the sideline. And they're sitting back going, well, when do we get back in? You know, do we get back in now and suffer a correction? I think my personal view is you can't make a judgment as to directional. I don't have a directional bias. I'll trade the market down and up. It doesn't bother me. I won't take a position that is so opinionated that the market has to do something for me to be right. I don't trade like that. I think that's dangerous. You know, it's like someone telling me to short Tesla at $300 a share. You know, get out. Like, you would have lost. You know, no matter what your opinion was, you know, it's not worth it. I think what you've got to do is you've got to say, let's appreciate the fact that that could happen. And if it could happen, why don't we just prepare for it? Buy cheap insurance. Do a put butterfly for a couple $100 every couple of weeks, and give yourself the flexibility that if the market does drop, you've got that protection in place. It's cheap.
So what are some strategies? I was going to actually ask you about that. I know that you're a fan of whenever there's some uncertainty with the market and the internals, or like long weekends, or just odd stuff that you do insurance trades. You want to kind of talk about those? Like, different ways you can do that to do hedging.
So I don't necessarily like hedging. I think the concept of hedging itself, it's like throwing good money after bad ideas, right? So you know, hedging for me is, I've got a very long portfolio. I'm very bullish on my portfolio because the market itself is in the strong trend, right? If the market started to look fragile, right? And how do you know if the market's starting to look fragile? You start to see the exponential moving averages starting to turn. The short ones, the short duration ones, will start falling below the longer dated ones. It's a very simple signal to watch. Once that starts to happen, you can insure your portfolio in many different ways. You know, you could short the shares, sell short the index. Okay. Very simple way to do it. It's expensive. Okay. It's expensive in terms of buying power in your account. That's one way. Second way to do it would be to buy long dated put options. All right. So buy them out 90 days at a delta of 60 to 80, somewhere around there. Make sure you're not overpaying. That's the second way that you would do it. All right. So I would buy the long put a trailing stop order on it. So if it does drop 20% in price, the bullish side of my portfolio has already made back that. So I'm not going to lose anything on that. Right. That's the way that I would do the long.
You're talking about like a put on SPY or a QQQ.
Yeah, just maybe NASDAQ. I think, you know, I would do QQQ or something. I wouldn't do individual stocks. I would just do the index.
Yeah.
And then the third way to do it is to look at what we call a put butterfly. All right. And a put butterfly operates under the concept of, if I know that the market is expecting a move to the downside, right? Remember, the expected move of a stock is in two directions. It's not going to be only one direction. We would use other indicators to tell us whether it will be to the upside or the downside. So let's imagine we're in a bullish market, but we can see some fragility around VIX. We can see some things around some of the indexes. We can see some of the momentum is starting to stall. I could do any one. I could short the shares, buy a long put, or I could do the put butterfly. So the put butterfly operates under the pretext of the implied move. All right. So if the implied move is $10, the market is saying that this price of the index could drop $10. What I want to do is use a triple leg butterfly, so three-legged butterfly with the middle strike on the call on the put butterfly at the implied move. And what I'm going to do is I'm going to sell two of those, and I'm going to have one wing to the downside, equidistant, right? So I'm going to have one wing to the upside, one wing to the downside. I'm going to buy those. So I'm going to buy one, sell two, buy one. And I just put that in, and I put it out 2 weeks in advance. So every 2 weeks, I'm just going to do it. Probably cost me a couple $100. If the market drops, I make a few thousand, right? That's the way it usually works. It's usually like a 8 to 10 times return. But the idea is, if I win on my insurance, and this is the thing that you should always remember in a portfolio that's largely bullish. If I win on insurance, I've lost somewhere else. So most retail people don't understand the concept of neutrality, right? Because what they do is they go bullish on the one side, buy this insurance, but they want to win at the same time on both. You can't. You can't win short and long at the same time. One can only work, right? So if I've lost on the insurance, I've gained on the bullish side. If I've lost on
the protection or some partial protection.
Yeah, I pay for it because it's like car insurance, right? I can't really get the premium back on my car insurance. And honestly, I don't really want to claim on my insurance, right?
Right.
I've got it there because in case something goes wrong. And it's the same thing that you have with call butterflies. So if I've done a put option, a long put, my degree and speed of loss, if the market moves up, is quite fast, all right? Because my delta would be quite heavy because I've accommodated a drop down in the market. So insurance and hedging is something that I will only do once I've got confirmations on signals. I don't do it just randomly. I'm not going to throw it in there under the guise of, oh, well, I've got too many long positions, so I need a hedge. Most people lose more money on hedges than anything else because they don't work. I don't think that they are something that you should be throwing on without thought. So, if someone comes to me and says, I'm sure, the market's going to correct. Okay, well, good luck to you. Tell me when you would do it. I'd rather you did, let's look at a case in point.
What about finding bearish trades?
Well, finding bearish trades is a little easier. What you're looking for is stocks that are trading below the moving averages, because as soon as the 8 goes below the 21 and the 21 goes below the 50, now you've got something. So bearish trades with the setups that I look for are price must be below the moving averages, preferably. And then the second thing is you don't just short because it's below the moving averages. That's a crazy idea, right? You look at Tesla. Let me pull up Tesla here. I had one client call me this week and say, should we short Tesla? All right, Tesla, there we go. And I looked at him and I was like, well, not yet. What I want is confirmation of trend. And he goes, but it's falling. I go, yeah, it's falling, but I want to see this test the 8. There's the 8 and fail. If it tests the 8 and falls down, this trend is starting. That's the start of a trend, is the test and the fail. It's not you don't short Tesla here. All right. If you short it here and you have this, you're out of the trade. You're dead. You short it on the test to the 8 and the fail. So test, fail. Okay, now I can short it because it failed here. So failure of a retest, failure of a moving average, where it establishes resistance as opposed to support, that's the mentality you have to have. It's the setup. Everything in trading is the setup. If I look at the graph, what types of trades would I be looking for on Tesla this week? Well, if I look at it, I have a lottery trade on Teslas because every time Tesla gets into these negative squeeze here, when it has this negative squeeze, they don't last very long. and they can bounce really fast. Tesla has a unnatural ability to, perform the Lazarus move. Just when you think that he's out and done, he bounces up and kicks you in the nuts. Okay, so I've often been caught, full disclosure, I've often been caught on the wrong side of the Lazarus trade. Every time I thought that I had, it's like WWE, the Royal Rumble or whatever it is, and you see the guy holding him down, and the referee's going 1, 2, and then as the hand's about to come down for the third, he kicks out, and
Right.
the crowd goes, yay. Tesla's like that. Tesla's the guy at the bottom after the people's elbow. He kicks out, right? So what you've got here is you have to wait and see. I think that this could bounce. I might be horribly wrong, and I'll lose a little bit of money on that put option. Oh, sorry, the call option that I've bought for here. But I might be right. And if I'm right and this thing goes up to $1,000, I'm going to be able to go and buy myself a Tesla. So I'm pretty comfortable that I'm taking a risk reward. My risk is very small. It was a cheap contract. Let's see what happens. So effectively, you don't want to short things until you've got establishments of support and resistance. You need to know that. Most guys would be looking at Tesla and going, you know what, Tesla at this price here was overextended. Tesla has always been overpriced. All right. There has never been, certainly for the last 2-3 years, I don't think Tesla's ever been priced fairly, with a PE of 1,000 or whatever it is. To me, it's just nonsense. So you would have some guys looking at the fundamental valuations of Tesla and going, you know what, let's short it here because it's too expensive. Okay, well, good luck to you. If you shorted Tesla at 450, you're out. You've just blown up because you don't short that. You can't short this, right? So what you look for is chronically weak companies that are trading below their moving averages. Because if I've got short, I don't really want to look for stocks that have got high short interest. I don't want to short what's already shorted. That's a little bit
in the squeeze.
Yeah, I don't want to do that. So the ones that we're long in, Shoe Carnival, we've been long in this stock and it's up. I think we're up about 30 or 40%. And if you look at it, short float is pretty high, but this stock is profitable. Look at this. It's growing. Why would you short a growing business, right? This is the thing. It's actually worth something. Pretty overvalued. But I like the fact that EPS has been growing this year, next year, and for the next 5 years. The management are assuming it's going to grow. So we've been long in this trade. It's up 30 or 40%. Another one that we've been doing is Play. This one's up nearly 70% for us. Why would you want to be shorting the stock? Look at this. EPS next year is expected to grow 75%. Sales are down. We get that. It's a pandemic. But this stock, I like this. It's still a growing business. And it's done well for us. We're up 70%. So simple way to find stocks worth shorting. And I certainly wouldn't suggest anyone goes out and shorts now. There's a lot of stuff that's positive. What you want to look for is below the 20, below the 50, below the 200. Sorry, price below the 200. There. Okay, so that would be my first screen to look at. Would be how many stocks can I find that are below here. Then also what I want stocks that are quite overvalued. All right, maybe over 10 times book. Right, I'm just throwing these numbers out. That might not be what I'm looking at, but to give you an idea, what I'm also looking for is very expensive stocks with a high PE. Okay, let's see. Okay, RKT. Let's have a look at that stock and see where we are with this one. So came all the way down. Let's have a look. So you can see here, fell down below the 8, tried to go back to the 8, failed. Firing short. This would be an interesting one, but I'd probably buy a put option on it. Let's have a look. Maybe buying a put option or a bear put spread, somewhere. Let's see, maybe go with the 60. We buy a bear put spread. Implied move here is $4. So we do the 24 and the 16. This is just a very, back of the envelope kind of trade that you could do. Here, you're not getting a 1-for-1 return. So this is not a good idea because I'm not getting enough value here. Maybe if I lowered the strike of this. Maybe I put it down at 21. Let's have a look. All right, here's 1 for 1. I'm going to risk $214 for 286. And what I need is for this stock to get below 1886. So if I go 1886, back to my chart, 1886 is here. Can this stock fall from here to here? That's the bet that I'm going to make. So it's the whole thing is about a process, right? You need to have a sort of system of logic. You wouldn't just go into this trade and go, you know what, I'm going to short this share. I would also want to be looking at its ADX. I want to look at its RSI. I want to look at its MACD. I want to look at a lot of these other indicators to tell me that that's going to work. Because always remember this, when you're shorting the stock, you are going against the natural order of the market. Because stock are designed to go up in price. So when you go against the market, when you go against that natural order of things, you really want things to be in your favor. So I'm looking for more and more confirmations of things. So ADX, RSI, MACD, all of these things need to line up. They all need to be pointing negative. I need to have negative momentum firing short on the squeeze indicator. And I need to see a fail of the 8. And then
so you've got a set of conditions, just like if you're going to go long.
Absolutely.
These conditions.
Absolutely.
Right.
There's short conditions and long conditions. So this is the sort of takeaway for everyone who's watching today is have a plan. Don't be seduced by the simplicity of things. If someone says to you that this is simple, question it. All right? Question it. Because there's always something that's not being said. I find that a lot of these guys who are saying it's simple aren't telling the truth. Not because it can't be simple. Don't get me wrong. It can be simple if you've done the work. If you've got a plan and you know how to operate the trades, it can be simple. But if you're going in on a 3-day course and expecting to be an expert, you cannot fight a war with one weapon. You know, it's like going onto a battlefield with a small little 6-inch knife and your opponent's got an AK-47. You're not going to win. Yeah. You might think you've got a weapon, but you haven't got the right tools to win. So
I think from my experience, it's just, as you know, obviously I've not been doing this nearly as long as you, but the way I see this is that, you know, people can learn if they want to and they're willing to put the time in. I think there's a lot to it, but I don't think it's so complicated that people can't learn it if they're willing to put the time and effort into it.
Yep.
But most people won't put the time and effort into it.
No, it's a hack. Everything's a hack today. You know,
you want like to download the app into your brain, like you were saying. It's this plugin. Everybody wants the reward without the actual.
Absolutely, can't agree with you more. And it's the same. Think of it like in fitness. Everyone wants the diet pill that's going to make them get, you know, a 6-pack, but they're not willing to do the crunches. You know. Same thing here. Everyone, you know, when you look at these people in jiu-jitsu, how quickly can I get a stripe? How quickly can I be this? How quickly can I be that? Jiu-jitsu is actually a really good metaphor for options trading. You know, you go learn one strategy. You've got one stripe on your white belt. The opponent that you are fighting every day in the market is a 4th-degree black belt. You really think you're going to win?
Yeah, it's like you're going. I mean, you have to have all the different positions, and as the game changes, fight from your back, fight from the top, get the takedown, whatever.
Yeah, you've basically learned how to shrimp, and now you want to go on to the. You know, you have no submissions, you have no tools, you have nothing, and yet your self-belief is one of I'm going to win this game. You know what? When you get tapped out, and that tap out could be a simple choke and you tap, or it could be a broken hip or a broken arm. Your recovery is going to take a little, you know, it's going to be a little different, right?
Well, like I don't know, I may have mentioned this, but I've had those guys before that have come by the gym, and you know they're usually younger, and they're doing their MMA fights, and a lot of these amateur MMA fights are kind of like two really, really unskilled people smashing at each other. You know, because it's just a grassroots thing. I mean, you know, they've not been training that long. You know, maybe a high school wrestler or something decides he wants to fight, and they'll come in and they're like, I need to get some jiu-jitsu for my fight. And I was like, well, when's your fight? And it's like next week. Like, so just stay off the mats and don't get hurt.
Yeah.
Really, I mean, you can't really do anything in a week.
It's a way that I see it too. It's like in options trading, I would usually, that's why I say to people, if you come to me and you want me to teach you for 30 days, I don't want you to trade for real.
Yeah.
Like just no trading. I just want you to paper trade, because I can only help someone if I know who they are, like the personality that they have. I don't care if you want 50 grand a week or 5 grand a week. It doesn't bother me. What I care about is your personality. If you're only driven by the vulgarity of winning, this is the thing. It's the same thing in jiu-jitsu. It's like the same guy, the one who, he gets tapped out in class by his teammate, or he taps his teammate out and he's hitting the mat and he's like, woohoo, the hyper celebratory kind of fighter. If you're a trader, a retail trader that is motivated by the vulgarity of money, and I'm not saying money is bad, but the way we display success with money sometimes can be a little over the top, then I probably don't want to work with you, because my approach to this is far more internalized. I don't care what people think about, my result. I know my results win. I know that I'm a better trader than most people, because I know my results consistently are hitting numbers that others don't get. Right. So I don't advertise it. What's important is vulgarity of winning will set you up to lose, because you'll start taking bigger risks that you're not even aware of, and then you lose. And when you lose, your ego will not be able to tolerate that loss. And that's when revenge trading comes in, and all of these other sort of, my dad didn't love me kind of stuff. You'd be amazed.
It does dredge up a lot of negative emotions.
Oh, man.
I had that early on. I had to.
Oh man, it's
things
crazy.
that I didn't think that I was going to deal with. It's kind of crazy.
Most people see this as a very external thing, right? It's like, well, I just do the trade. I just copy the trade. I do this, I do that. It's not about that. You bring, every day that you sit in front of your screen looking at this stuff, you bring your beliefs and your opinions. Whether you like it or not, you bring. And if you're not aware of how those beliefs and opinions shape the ability for your brain to connect your fingers and hit here, you're missing out. You're missing out. This is a much deeper journey than, making it rain, gold chains, girls in bikinis, kind of, jets.
Breaking my heart, Chris. That's what I'm going for. That's what.
Listen, you're gonna do it, but just don't invite me, man.
All right.
No, you can. I'm just kidding. You can.
I will. No, we'll do it. I won't do it on
incognito.
Exactly.
Well, yeah. It's exactly. Just the thing is, I respect the process.
Right.
There's a process that needs to be followed. It doesn't mean you have to lose. Don't get me wrong. I don't want people to lose. I want them to have a process that works for them consistently, so that they can turn around and say, you know what? I am a trader. A trader is not vulgar in their demonstration of success. So when I see these guys renting out a jet on an airstrip and saying that you could have this too if you come to my $25,000 course next Saturday, that's, I don't know. I don't think I see any professional traders that admire that, because it's just not real.
Right.
Anyway, well, bells have rung.
Always appreciate your perspective on everything, and thanks for if you have questions, comments, leave them down there, and we'll try to get those answered for you.
Awesome, man. Thanks for the chat, Brian.
Yeah.
Have a good week.
You too. Take care, Chris.
Take care, buddy. See you, man.